The US Central Bank, the Federal Reserve, sets interest rate policy for the United States, but it affects markets all over the world. And that's why it's important to know when the Fed is going to finally raise interest rates. So in this video, we're going to look at a really simple model which forecasts when that will happen. And I think you may be surprised by the forecast. So now let's look at when the Fed's going to raise interest rates in a bit more detail. Now, when the Fed raises interest rates, it's very much like a rocket launch in the sense that it requires a lot of planning. But also the Fed has to communicate with the market so that it doesn't freak out and sell off a lot, as we saw in the 2013 taper tantrum. But somehow it always seems to freak out markets when it happens. And I suspect that'll be true this time around as well. So a good place to start is what the Fed's communicating right now. The committee that sets US monetary policy is called the Federal Open Markets Committee, and they publish this notorious plot, which is called the dot plot, which shows the projections from individual members of the committee on where they expect rates to be in the future. So the 18 dots, which you can see underneath me, each of them is a forecast from one member of the FOMC committee. And what that tells you is that none of them expect an interest rate rise in 2021. And you can see that by 2023, only 5 members of the committee expect that rates will still be at the lower bound. Everybody else in the committee thinks that there'll be at least 1 rate hike by that point. And 2 members of the committee expect 6 rate hikes by the end of 2023. So what are the drivers that make the Fed raise interest rates? The Fed created this document in 2012, which outlines exactly how it goes about achieving its goals. But its mandate from the US government, from Congress, is essentially twofold. The first mandate is stable prices. What we don't want is a Weimar Republic kind of runaway inflation where money becomes worthless. And we also don't want deflation because that usually comes hand in hand with terrible economic consequences. The second part of the Fed's mandate is to achieve maximum employment. So you can think of the Fed's mandate as a kind of bullseye on this two-dimensional graph, where the x-axis is the rate of unemployment and the y-axis is the rate of inflation. And although the Fed will never exactly achieve the bullseye, it does try to keep the US economy within this range for these two variables. So you can see that that's around 4% unemployment, and they want to keep inflation at around 2%. So coming back to the present day, let's look at their first mandate, which is stable prices. What that actually means to the Fed is a particular measure of inflation called personal consumption expenditures inflation, and what they're trying to do is to steer that to be around 2%. But if you look at the actual rate of inflation after the global financial crisis, you'll see it spent much of the time below the Fed's 2% target. And that's why the Fed has now shifted to an average inflation targeting approach, which is to say that if inflation's been running persistently below 2% for an extended period of time, then the Fed is willing to let inflation run a little bit hot, that's moderately above 2%, for some time. But it's been very careful not to say what the averaging period is or what moderately above 2% actually means. Here's the actual PCE rate of inflation since 1960 for the US, and that's the blue line. And what I've done is average it over a 2-year period. Now, the Fed hasn't said that it uses a 2-year period. That's just my guess of a reasonable averaging period. And as you can see, inflation spiked after the pandemic for reasons everyone's discussed, which is base effect and bottlenecks in supply. When you look at the 2-year average, which is in red, that's still well below the Fed's 2% target, which is the dashed red line. If you look at a breakdown of the inflation by component over the last 12 months, the two components which really stand out are energy commodities. So if you look at the price of gasoline, it's up 45% over the last 12 months. And if you look at the price of used cars and trucks, that's also up 45%. Now, the 45% spike in gasoline will be short-lived because the base effect will roll the window past the very depressed prices that we had last year. And the spike in used cars and trucks, which is indirectly a result of not having enough chips for new cars, I expect will also be short-lived. And that's because chip manufacturers will increase supply to meet the increased demand. And when you combine that with the fact that the Fed is now average inflation targeting, I think that means it's unlikely that inflation will be what drives the Fed to raise interest rates. And this is also something I discussed at greater length in my weekly market roundup, which you can sign up for free. There should be a link in the description if you want to do that, or there should be a link beside me. And my guiding principle when I write is to try and keep it short, accurate, and focus on the macroeconomic stories which are most impactful on your investments. So if price stability is not going to drive the Fed to raise interest rates, how about its second mandate, which is maximum employment? Below me you can see the unemployment rate for the US going back to 1950, and that's the proportion of people who are in the labour market who are currently working. Now the blue shaded bars which you can see are US recessions, and one thing this reminds me of is when you ring a bell. Every time there's a recession it's as if you've struck the bell and started it ringing. And then what happens gradually over time is that the ringing of the bell gets quieter and quieter. And if we look at the last 3 recessions, the rate at which the unemployment rate falls away has tended to be fairly constant. The halving rate has been just under 4 years. And what characterizes the pandemic recession is its rapid onset, but also the scale of unemployment rising so high. But what also characterizes the pandemic unemployment rate is that it's also recovered very quickly. Now I've told you that the halving rate is about 4 years, and to show you that that's true, we'll look at the period between 2012 and the onset of the pandemic. And the model that we're going to use is a very simple one called exponential decay. This is a very widely used model in physics, and you can see it's very simple. You start off with a high value, and then the amount halves in a certain time period. And the line you can see here in red is an example of fast decay, where the halving period is very short. Whereas if we got slow decay, which is the blue line, the halving period is much longer. So the 3 variables you fit with one of these models are the starting point, the end point, and the time period for halving. And in the case of unemployment, it makes sense to have 2 components by adding those 2 graphs. So we have a fast decay component. Those are the jobs which are recovered very rapidly after a recession. And then we have a very much longer tail. You can think of that as scarring in the economy. And that's the part of the jobs market which takes much longer to heal. And if we apply that to the unemployment rate after the global financial crisis, the starting rate of unemployment, which is the first parameter we'll fit, is 8.8%. The end point, which the model finds, is 2.1%. Now that's extremely low unemployment, and it's where we might have got if we hadn't had the pandemic. And the time for unemployment to halve following that shock was just under 4 years. It was 3.5 years. And although I let the model look for a fast component in this data, it found that there wasn't one. It was 100% slow recovery with a 3.5 year halving period. So let's use what we've learnt to build a very simple forecast. Now nobody really knows what maximum employment means, but the Congressional Budget Office publishes an estimate of what it is for the United States. And that's the red line that you can see beneath me. So what we can look for in our model is the point at which the black line, which is US unemployment, meets the red line, which is the estimate of full employment. And I think a reasonable assumption for the end point for unemployment is that it reaches a level we saw just before the pandemic hit, which was unemployment of 3.5%. And if we make those assumptions, the red line, which is extended now, is what the model forecasts for the rate of unemployment. The extremely high starting point was 15.2% according to the model, and the model finds that there is now a fast component and a slow component. So those rapid job gains make up 80% of the recovery, but there's an obstinate 20% of jobs which take a very long time to recover. And according to the model, the halving time for the fast component is just over 2 months. So much of that fast component has already decayed away. So we've seen a lot of the quick wins already. But what I've assumed is that the slow component will be the same as it was after the global financial crisis, and that's a time period of about 3.5 years. And here's the moment of truth. The model forecasts that we'll have full employment by 2025, in the middle of the year. Now that's 4 years in the future. In other words, I think many people have underestimated how long it'll take for the scarring to go away after this pandemic. I always try to be optimistic when I look at the future, and it might be that this is too pessimistic. For example, perhaps the American Rescue Plan will stimulate the economy and create jobs much faster than we'd expect, when we compare it with the global financial crisis recovery period. Or perhaps inflation will surprise on the upside. It may not be transitory as the Fed expects, and it may be that we get sticky inflation which lasts for some time, and that may force the Fed's hand to raise interest rates sooner than this model would predict. So I think what this really simple model shows is that economists and markets might have just been too optimistic about recovery from the pandemic, and that these scarring effects might last much longer than people think. But why not tell us what you think and share it in the comments below this video? I'd love to hear your thoughts. And as always, thank you for listening.